Testing, testing.
Right, welcome everyone to this evening's Audit Committee. I do need to say that for those in the room, there are no fire drills planned this evening. If the fire alarm does sound, please leave the building via the nearest exit and gather at muster point 2, which is in the car park at the rear of the building. Okay, do we have any apologies?
Councillor Jorgensen.
Okay, thank you very much. And just before we begin, I just wanted to extend my thanks on behalf of the committee to Sandeep Vig. Sandeep served on this committee as an independent member, but unfortunately for us, he's had to step down due to expanded work commitments. So thank you from all of us to Sandeep for his service on the committee. We're really sorry to lose Sandeep, but obviously we wish him well, and we will be looking to recruit a replacement independent member, because we know that they do provide us with really valuable insights for the committee. So thanks from all of us to Sandeep. Andrew, would you be able to just introduce the officers and others that we have at the meeting this evening, please?
Okay, thank you, Chair. If I start with people online, so we've got Mike Drake, our independent member, who's online this evening. Then Jonathan Brown, partner from our external auditors, KPMG. Graham Cadle, who's the Service Director for Finance. Mark Thompson, Chief Accountant. And Paul Oshen, just checking Paul's there, Paul Oshen Ellis, who's our Governance and Risk Manager at the Council. And then in the room, we've got to my right, Graham Ebers, Deputy Chief Executive and Director of Finance and Resources. Catherine Hickman, Head of Internal Audit and Investigations. Madeline Shopland from Democratic Services, and myself, I'm Andrew Moulton, Service Director, Governance.
Great, thank you very much, Andrew. So minutes, can I see a show of hands of people happy to sign those, for me to sign those as a correct record? Yep, okay, thank you. And any comments on the actions list? Are people happy that the actions are being progressed sufficiently? Good, okay, thank you. Are there any declarations of interest? Yes.
Thank you. Can I declare an interest, please, in item 43, the corporate risk register? It's my normal declaration in risk 14 because I'm working with foster carer. Thank you, Chair.
Thank you. And do we have any public or member questions? No. Okay, so we'll get on to the substantive agenda for the evening. We've got quite a lot of important things to cover. A key item of business, obviously, the completion report from KPMG and the accounts for 2022-23. So I will allow a suitable amount of time for those items. I do note that since the last committee, we have had a training session on local authority accounts, which was really, really useful, and it did focus on this set of accounts as a draft. So hopefully that will be helpful to the committee. We've also got the draft internal audit plan coming up later as well, which is a key paper for us to review and input to. And I just want to add a very brief item at the end on the forward programme as well. So just a couple of points for me to make there. So first item on the agenda then is KPMG's completion report. But just to say, for these next few items, items 39 to 42 are obviously intrinsically linked, so we will go through them in order. But in terms of the recommendations, I'll leave those till we've got to the end of item 42, so that we've sort of discussed all of them before we come to the actual recommendations, if that's okay with everyone. So, so over to KPMG to introduce their completion report then, please.
Okay. Thank you, Rachel, and good evening to you all. As just mentioned, we have two reports. One is the year-end report to the Audit Committee, and then the other one a bit later is our annual Auditor's Report. The first one is to the Audit Committee. It's it covers everything that the international standards of accounting say we have to report to you in ISA 260, hence a lot of people call it the ISA 260. That's very much the judgments, what we've done, and then the later report is very much a summary of all of our work written for the layman that then goes on the website. So this is the more internal piece. So first of all, I'll just go through the highlights if you like. So we've completed our audit. We've done all the work that we planned to do when we last met. And that's fantastic. Let's take stock. There was people challenging us whether we got the right team and whether we could do it in time, and how long others had taken to get to similar positions. We completed our audit. We've done everything we wanted to. The significant risks that we cover a bit later around pensions, around land and buildings valuation, around investment property valuation, all those sticky things from previous years we've audited and we're happy with. So many thanks go to the team, the finance team that have gone through lots of heavy lifting in terms of getting to know us as new auditors, responding to our challenges, responding to our questions. So I'm really pleased, and I know Graham is too, that we are where we are, and we've got through it all. In terms of the preamble to the report, it reminds us where we've been, if you like, in terms of the 2 years of disclaimed opinions and the impact that has on our opinion, which will still be a disclaimed opinion, but it's disclaimed as a result of the opening balances, and there's lots of guidance in the what we call the LARIGs, the local audit, the kind of guidance on how do we get to where we want to be in the future, and that says we should disclaim this opinion, but only in respect to the opening balances. So apart from that, we are happy, and I must say, compared to other local authorities that we audit, both me personally and KPMG wider, not everyone will get to that point in terms of everything's happy apart from the opening balances. We've had some issues with some in-year balances on other clients. So very much that's the preamble. If I move to page 6, which is meant to summarise our audit on a page, the significant risks are the areas where we focus the most work. So we look at management override of controls, where have management got the ability to influence and to post journals and to move judgments. And we didn't find any particular instances of management overriding controls or trying to manage to a set position. In terms of the valuation of land and buildings and the valuation of investment property, again, we checked out your valuers, we talked to them, we looked at all the inputs and the details that they had. We challenged them compared to other similar assets, and we're happy that those valuations, as at the end of March, were appropriate and balanced. We looked at the pensions a lot, so both the underlying assets held in the scheme, but also the membership data that you're basing your calculations on, and then the actuarial calculation that uses a number of high-level assumptions in terms of growth rates, discount rates, etc. And all of those were within our balanced, within our acceptable range, and overall that was in our acceptable range. So we believe the pensions obligations are balanced as well. And then the final significant audit risk was fraud risk around expenditure recognition. And again, we've been through that and didn't find any expenditure that was materially misstated. In terms of audit misstatements, you'll see that we've corrected some, relatively minor in the scheme of things. We did identify a very odd and a very novel reclassification between year-end cash and debtors of 10.4 million, and we might talk about that later. That those have been corrected by management. There's no uncorrected audit misstatements that would have any impact on the bottom line, and we've made a number of control deficiencies, which I'm happy to go through. But I will stop there. That's very much an overview of our work, and I'm sure, fueled by your recent training, you will have a number of questions.
Thank you very much for that. Right, open it up to the committee. What questions do we have on the audit process in the report? Okay, shall I kick off then? Oh, sorry, go on, Rob. No?
I was just throwing myself in to start off. A couple of just general ones, I guess. When you were mentioning the LARIGs earlier, you were talking about obviously having to issue a qualified opinion, which I understand completely. And the suggestion appears to be that there's a possibility that you may or may not end up doing a a disclaimed opinion next year. But it also says that that if you can get sufficient assurances during the year, then you may be able to not do so. I'm just wondering what steps you and we are taking to ensure you get those assurances to try to avoid having to make a disclaimed opinion for the 24-25 figures. A second or supplementary question is, I looked at the number of corrected audit misstatements, nearly all of which are reclassifications, so that doesn't fuss me too much. But is that typical for the number of those for a local authority of our size?
Okay, so I'll start with the first question, and I've had a go at this already because Graham's been on my back, Graham Cadle, about exactly the same question. How do we kind of get off from this disclaimer or qualified, and what can we do? What can we do more, etc. So there are a number of things that play with the LARIGs in that. The question is how do you get happy with the opening balances? So those areas where you've got opening reserves, where you've had two income statements that you don't know everything that's thrown through there is correct. So there's two ways to do it. You either go back and look at those 2 years in a level of detail that gives you that assurance that everything's flowed through correctly, or the regulators are working together to see if there's a shortcut to that. So auditing standard says you should do this. There is a view that will take too long, and people want to get back onto this even footing as soon as possible, and therefore the regulators are talking about is there a short circuit where we could somehow rule off and say, you know, just speaking out loud, you know, we've got some deemed reserved balances here, which would mean that we wouldn't need to go back into the level of precision that we might otherwise have to. So there's a little bit of discussion with the regulators to see if they can short circuit that. The other step, if they don't agree, that is we will go back at those 2 years and do some test work, which the LARIGs refer to as building back assurance. And effectively we go down the balance sheet and the income statement and say, okay, we're happy with land and buildings at March 24. It was this at March 23. Can we this at March 22? Do those look sensible when you roll them back? And if they look sensible rolling them back, then we should be able to rely on those going forward. So we'll do everything we can to do that work in 24-25, and very much Graham's given the commitment that that's management's view as well, that they want to do everything they can to make sure we get there, and so it won't be for lack of trying.
Okay, thank you. Any other comments? Sam, and then, yeah, Steve.
Yeah, thank you for that. Just you mentioned some of the additional control efficiencies that you've put in place. Could you sort of talk through what they might be?
Yeah, sure. I first of all, I forgot about part 2 of the question, so apologies. I'll just go back to that. We made some misstatements. I think it gives you assurance that we've been through it with a fine-tooth comb, which we have. And certainly George, the kind of auditor that was on the ground and led the kind of on-site team, if you like, he is like a dog with a bone. So certainly I think you would be unlucky. I could say you were unlucky getting that number of misstatements, and others we could have pushed them all together and kind of summed them up. But I don't think there was anything that was indicative that the underlying control environment that you're going to find a big error. Yes, there's a bit of tightening up around the capital, in particular in terms of assets under construction, when things moves from assets under construction to operational, and you can see some of the themes from those in our control deficiencies. But apart from that, I wouldn't read into anything about the number of corrected misstatements. Then going back to the second question about recommendations, which is right at the back in the appendices. So first one we had was around journals. So journals can be edited by approvers, and effectively they can then post them without being reapproved anywhere. It's a relatively common issue we see in certain systems, and auditing standards say, well, we have to flag that as a control deficiency, because ideally you would reroute that back through the approval process, so you can see the management response in saying that it's not that they don't think it's a fundamental and material risk, but they are going to look to see if there's anything to make those changes. The other control deficiencies are lower priority in terms of, like I've said, project managers informing the capital accountants when something becomes operational and hence needs to start depreciation. So during our walkthroughs, we found a number of those. A key theme we're seeing a lot across our client base is over the last 3 years, I'd say the regulator's view of audit has changed, and the feedbacks from their regulatory inspections are where management have instructed a valuer or a pensions actuary to produce a valuation, they would expect some in-house challenge of that, maybe the data that's gone there, maybe to various benchmarks before we see it. And so that's another recommendation, that kind of in-house check and sense check before we get it would be useful. So those were the key recommendations.
Thank you, Chair. Yeah, my feelings around this was it was a really positive report. It was nice to have something that actually had some substance to it and wasn't just sort of, we don't know what this is in, we can't tell you anything. So I thought this was a really good and a very clear report. And I will come back to one question I've got on that, which is probably just my ignorance. But it seems from what I'm reading here that the relationship with the officers is very strong. It started off in a good way, and there's a good relationship and a good flow of information, which is very, very encouraging. So I just want to sort of applaud everyone involved for that. And also for what I felt was a very clear and concise report. So thank you for that. My question, if I can refer you to page 6, and this is just me, I think, being completely ignorant. In the first box on the left, you've got about valuation of land and buildings. And you've said that we found the valuation of council dwellings and other land and buildings to be appropriate. But for the other things, the next one, investment property and post-retirement benefit obligations, you said you found it balanced. And I just wondered what the nuance was, or am I just missing the point completely and reading too much into it, between what appropriate means and what balanced means?
Yeah, no, absolutely. It's just, we get bluntly, how late at night we've built it in. So I would take them to mean the same thing. So you know, we talked to the valuers, we've looked at the underlying inputs, what you've got, how old they are, what they're being rented for, etc., etc. Looked at the beacon valuation and you know, their balance compared to what we see elsewhere and what we'd expect from our real estate valuation team.
Graham,
So I can update that to balanced if it's easier.
Graham Evers, did you want to come?
Yes, thank you. I just wanted to pick up on the point of the strategic relationship we have with KPMG and put that into some context. I've been presiding over these accounts at Wokingham as CFO for 22 years, and it has never been as bad, painful and concerning as it has been since about December 23. Obviously, you'll know this is a national issue as well as a local issue. And I guess in some ways I've taken for granted a good, healthy, open a two-way contractual relationship in terms of we both want to get to the same outcome, and we both have to put the work in order to make it, get things to conclusions and what have you, and work through issues. What I can say is, having gone into probably the darkest place, well, the darkest place from a statement of accounts perspective at this council, like I say, aligned to national position as well. The new relationship we've built with KPMG is an absolute breath of fresh air and is a huge step in the right direction and absolutely vital, because without that, it is two-way. We have to discuss our own challenges, our own issues. There's a lot of information and challenging and understanding that needs to take place. And I can just say, really, I think Jonathan and his team, they've been really, really good. They've delivered on everything they said they would, and they put a lot of work into fostering and maintaining a good, strong relationship with Graham Cadle, Mark Thompson and the team. And I just didn't want to let that slip, because that is so important. And it's always my keen intention, because I know it's important, is to maintain that healthy, challenging, but productive relationship. And I just guess I wanted to assure you we are back on a even keel, a promising position. I know we've got a lot of work to do to get to that unqualified set of accounts, but I just say from my perspective, it started off in a really great vein. And so to assure you and to thank KPMG.
Great, that's really excellent
Thank
to
you.
hear. Thank you for that. Could I just pick up on one of the points about this cash and cash equivalents points? So it's really a question for management, actually. So this is page 42 of the pack, page 32 of KPMG. We've got this 10.4 million error, which has been corrected, I know. But I'm just curious as to how it wasn't picked up. So you would expect, year-end, month-end reconciliations to pick this up, or if it's a sort of this unallocated cash account code, if it's a suspense account, you'd expect that to have been cleared and that for that to be checked as well. So, and this is also with the sort of backdrop of we have had an internal audit recommendation on financial reconciliations that's gone a couple of years, has taken a while for us to fix. So just with that backdrop, could I have some sort of management comment as to why that wasn't initially picked up? It seems like quite a large error that it should have been picked up.
Yes, thank you, Chair. Yes, it should have been picked up. The issue was that a movement of the money into the correct year, which required additional journal entries, and unfortunately they were done twice. So the way the general ledger was mapped, it just mapped one of the monies into the wrong area. It was all within the same subcode. You're absolutely right. It should have been picked up. It's to do with it being the end of the year and the number of accounts we had open and the different transactions from previous audits being followed through. There is now an additional journal control put in place. So if anything like that happens on the last day of a financial year going forward, it would be picked up immediately. I don't know whether there's anything technically I've missed there, Mark, but it should have been picked up. It was just done twice, unfortunately, in error.
Yeah, I think just to say, it was a unfortunate timing issue of a large treasury investment that was due to be repaid at the end of March, so it came into our bank account correctly. However, it got posted into our ledger in the following financial year, so we have the process of putting all that income back into the old year, and we had done that process correctly, but because we knew that the treasury management money was due in, we'd also duplicated that process somewhere else in the team, which led to that overstatement within current assets. So in previous years, we've never had that instance in such a big number on the last day of the financial year, but following this work with KPMG, we've added some additional checks around cash and cash equivalents to make sure we're tightening up on that process.
Okay, thank you for that. Any other questions on the KPMG completion audit? Yes, Martijn.
I have a question for Jonathan. You know, the risk journal approval, the auditor has sort of rated that as fundamental and material. Could you explain why you think that is, Jonathan?
Yeah, and again, we had this discussion a lot with management. So it's very much driven by auditing standards, and I would say if you picked up many councils' ISA 260 reports, they would have a similar recommendation, and it's basically says because we have management override of control as a significant risk, i.e. the ability for management to post journals, to move money around, to meet control totals and budgets, etc. Then any deficiencies in that environment should be recorded as a significant control weakness, and so that is what is driving that. Management's challenge back was, well, it's journals in the accounts, it's not cash going out or anything like that, but because from an audit point of view, the significant risk is management being able to journal things around to meet totals, etc. Then that's why we raise it as a significant control deficiency.
Just a quick, but we didn't find anything that this risk had actually that journals were approved or changed or modified. There was no evidence for that.
No, absolutely, and so going back to where I started, we didn't find any instances of it. It's just highlighting that the approver of a journal can change it and post it without it being reapproved by anyone. So it's more that there's ideally that system would be tightened up. But actually, when we've looked at that, seen who's done that, drilled into, effectively we take all of the journals that were posted in the year, suck them into our kind of data analysis exercise, make sure they all add up to the accounts, and then look for oddities, differences in approval patterns, things out of the ordinary, and then look at kind of high risk criteria. So we do an awful lot of work on that, and we didn't find any instances.
Okay, thank you for that. Any other questions for KPMG? Oh, Mike, sorry, Mike, go on.
That's right. Having sent you all my comments and said I'd sit in the background, you know what I'm like, Rachel. I'd just like to echo some of the other comments. I thought it was a very good report, Jonathan, and I really liked the approach of setting out the risks, your procedures and the findings. I thought that was a very good summary for the committee. I do have one comment that's rather following on sort of Rachel's theme almost. On your page 16, talking about controls and management controls, you mentioned that you couldn't rely on them, and I assume then did additional substantive tests. And I wondered what we need to do in the council so that you can rely on controls, and whether you would normally expect, presumably quite a big organisation like our borough, you should normally they should have controls in place that you can rely on, and hence reduce your substantive. Thank you.
Yeah, was there a particular comment on the controls that you were just say?
It's really in your general comments on page 16. Basically, that you couldn't rely on the effectiveness of the controls.
So we were obviously able to rely on some of the controls. So the comments we made are around, again, auditing standards as this high bar for management review controls. And at the moment, there are a lot of corporates and local authority entities that don't meet that high bar that auditing standards has. So for an example, journal authorization, albeit you have your somebody can approve and change it. Auditing standards would say, okay, if you're approving a journal, you should have an expectation of what you expect that journal to be, a range of tolerance, almost a decision tree on what you're going to do to that. And if you can show that you've followed that decision tree, then that would be an effective management review control. Nobody does that because it would cost too much. And so you do have some controlled efficiencies driven by auditing standards rather than specific issues. The controls around valuation of land and buildings, investment property and pensions is, again, the regulator would expect management to have some kind of review control before it comes back to us, where you've used third-party valuation teams. And then I guess the step back from the challenge is, you know, when we look across our other councils that we've done, I don't think your control environment is any different to any of those. So, you know, we would have relied on similar controls and have made very similar recommendations around the third-party valuation points as others.
Thank you. I think that's the confirmation I was looking for. So we're not an outlier. Generally, in the unitary authority, our controls are not untypical, and the fact that you're doing additional work is not untypical. Thank you.
Graham Cadle, did you want to come in?
Thank you, Chair. Yeah, if I can just add a couple of examples to add to what Jonathan's just explained. So I think with the journal, our view is, in terms of it being high risk, people can't take money out the organisation, but as Jonathan said, that they could move money around in our ledger, and therefore I think we accept that's an improvement we can make, and we've made a commitment in the report that we will get the systems changed or put something else in. With the valuations, we believe that actually the way those valuations are done are done with our external valuers. So our own valuers are giving the information to the external, they're discussing it and they agree it. What we don't do, and the point I think KPMG have picked up, is document that well enough that that's happened to be able to kind of give comfort that that process has happened. So again, we're happy that we'll put in that extra layer and we can you know, demonstrate that control's been in place. So they feel helpful, tying in with Graham Eber's comments earlier, that I think this has been a real value add process. First time we've worked with KPMG, so there's going to be an element of finding out a lot about each other. But I think they're, whilst not overly concerning, they're things that will add value and we'll put in place.
Thanks, Graham. Graham Ebers.
Yeah, just again, by way of assurance, this is a very small area. There's controls all over the place, and obviously internal audit, look at them. External audit over many, many years have looked at our controls. And I'm not for 1 minute rebutting these controls, and we need to do something. We're always ready to learn and improve. But these haven't been picked up and pointed out in any of the previous audits the councils had. And this isn't uncommon when you have a new incumbent. They have a different focus, a different way of seeing things, a different maybe standard in some areas to other areas. And so I think that's an important context as well. It's very common for a new incumbent to find things because they're looking from with fresh eyes, as it were.
Okay, thank you, Graham. Any other comments for KPMG? No? Okay, we'll move on to the accounts, the actual statement of accounts. And the first part we need to do is look at the annual governance statement. So in terms of our role in this is to look at whether it properly reflects the risk environment and the insurances that we receive. We last looked at this in September last year and found there was good assurance, but that there were areas for improvement. So the report we've got in the main pack, so page 19 of the main pack, looks at the progress we've made against those areas for improvement. So just start with that before we move on to the main set of accounts. Does anyone have any comments or questions on the AGS? No? Okay, I think the only one for me was perhaps on the Procurement Act one. So the new Procurement Act's coming in a couple of weeks' time. I know we are looking at it in internal audit, but I think it's in next year. I think it's the second year that we're looking at Procurement Act, so it's not straight away. Is that right?
We've just been looking at procurement, so it's an audit was finalised quite recently,
Yeah.
so that will come to the next audit committee.
And that will include how prepared we are for the Procurement Act coming in.
That's what we're
Okay, that's great.
Yeah.
Okay, that's fine. That covers that point off then. Thank you. Any other points on the AGS? No? Okay, so we'll move on to the actual main set of accounts. So we did have these as a committee, a draft version in advance, which was really helpful. We also had the training session, and we were able to put through some sort of detailed questions to the finance team, which was really helpful. And just thank you to the officers in the finance team for taking the time and care to answer those thoroughly for us. I thought that was really helpful. I don't know if Graham, Cade, you want to sort of introduce the accounts, or if there's anything you want to say further before we move on, or Graham Evers, did you want to? Graham Evers then.
Thanks, Rachel. I'll hand over to Graham, but I thought while I was here, I might as well say some words about the Statement of Accounts 23-24 and put some context around them. It is highly, highly unusual for us to be signing off 3 sets of accounts in less than 3 months, I think, which is not ideal at all, wholly irregular. It is normal to have a year in between. You settle down with your final statement of accounts, you get time to incorporate that into your baseline, then you have a solid baseline to work upon, and then 1 year later, you do your next accounts. Because we've had to condense that work into such a short period of time, it's been fluid. We've had 3 accounts on the go at one time. So I'm saying that to really stress the irregularity of this. We will be settling down. This is fantastic. If we can get 23-24 over the line, then we have a year to then work on the following year and get back to a normal cadence, which is vital. It adds a huge amount of stress to the team. So Graham, Cadel, Mark Thompson and the team have had 3 live accounts going on at one time, obviously working with different auditors as well. And the figures, because of that, 23-24 was never going to be a perfect set of accounts. We know it has to be disclaimed for the reasons KPMG have said, but also all this turbulence and fluidity around 3 years has made it really, really difficult. So it's in good state, and it's a massive step forward from where we've been. But I do want to assure you that those more trifling issues, and when I say trifling, I only mean in that it doesn't change the bottom line in any way, and therefore our financial sustainability, it doesn't do that. But that's why I say they're trifling. But of course we need to ensure we have 0 errors in terms of roundings, text or what have you. That will be our aim going forward. We have previously had nice clean set of accounts, and we want to get back to that. But I would say I think this 23-24 set of accounts is a massive step in the right direction. They're not that anywhere near as out of date as the previous ones. And I do want to stress the amount of work KPMG have put into this. And I'm conscious that some other audit firms have taken a much more cursory look in the world of disclaimed opinions, whereas KPMG have undertaken a really thorough piece of work, and I know they focused on the priority areas as well in the context they can't cover everything. So I just wanted to give you that by high level of reassurance, but also some context as to why they're not as clean as future years we would expect them to be. Sorry, Graham. C.
Thank you. Graham Cadel, did you want to say anything further?
Yeah, thank you. I'll try not to duplicate, but yeah, I think as Graham said, we're aware we've had to, with all those complexities, do this in a very short period. I think that's meant that we haven't maybe picked up some of those casting and rounding and improvements to maybe some of the text that I think we've been through in the last 2 or 3 months, which we will pick up for 24, 25. So we are aware this isn't where we'd be in an ideal world, but as Graham has said, we've moved on a long way in a short period. Just reiterate our thanks to KPMG. It has been a really collaborative arrangement, and added some value in that context. And I think that's probably all I want to do, other than probably just a particular thanks to members. You gave your time up for the sit for training, which I hope was valuable. And I think we have benefited from some of the challenge and input from your last meeting that will help us going forward as well. So that's welcomed and appreciated. Thank you.
Thank you very much. Right, any questions or comments on the accounts themselves from members? Rob?
Apologies. A question, if you like, on one of the answers I got to one of the questions. First of all, I'd like to echo Rachel's comments, and I think the work that the guys did to answer all the questions we put together, certainly from my point of view, was really, really good and really, really helpful. And I imagine it took a fair amount of work, and I'm particularly grateful because half of these questions are from me. So thank you very much for that. 2 good questions that I have. One was relating to the temporary relief on plant and equipment for infrastructure assets. There's some temporary relief which is explained to me will be coming to an end in 25-26. The only question I've got really is, the answer I got explained to me that there is a temporary relief, it will be coming to the end of 25-26, but what I don't know is, will that present us with a problem when the relief ends? Do you want me to, I'm happy to read out the question if I wasn't being clear, because I probably wasn't.
I can answer that, Chair, if that's helpful.
Yeah, please go ahead, Graham.
So yeah, so this was a matter that some members may remember came up halfway through auditing our 2021 accounts when we thought we'd got there, and then this national infrastructure issue came up, and SITFA took quite a while to do some consultation to try and find a way forward. Couldn't agree a way forward, and therefore this kind of hold was put on place. I think as Mark has put in the responses, we're doing, or we plan to do the work, so we don't think it'll be an issue. It's not such a big issue for us as it is for some other authorities. We don't know whether there will be any amendment to what that requirement is, but just there's a consultation going on at the moment around the future of funding, and there was one on the 24-25 settlement, 25-26 settlement, that actually asked our views on whether that interim arrangement would be extended. So we are in an good position for that to come in, but my feeling is that may well be extended a little bit further on. I'm slightly looking at Jonathan as we say this to see whether he's got an inside track, but I feel because they haven't actually resolved the matter, there may be a longer time period put on a solution.
Yeah, I think that's right. I haven't got that update.
Okay, thank you. Rob, did you have another question?
Yeah? Afraid so. Probably, again, a simple one. In the short-term borrowings and the Treasury Management comments, the short-term borrowings increased increased by 11.7 million, of which 3.8 came from movement from long-term borrowing. So that means that the actual short-term borrowing increased by around about 8 million. Is that normal? Is that something that one should be concerned about, or is that just business as normal, an increase of 8 million in short-term borrowing?
Graham, can you answer that one?
If I answer in general, and then Mark might be able to give us a little bit more detail about that, the timing of that, but often the movement between long and short term will be around the interest rates and the direction of travel. So if we have external advisors that support us with this, clearly, as anybody would do, if we feel the interest rate's going to go down, we'll take something a little bit shorter term and then look to try and arrange something at a later date. If it's going to go up, we might tie it in for longer on the rate it is. That alongside, obviously, when we expect grants, council tax payments, salary payments go in and out. So the Treasury management is a complete balance, and the balance between short and long term is taken with a view of what money we need, how transient it needs to be, and the way that the market's going. I don't know, Mark, whether you've got anything particular to add around that year in particular.
I'd probably just add doesn't give you the answer, but this is the borrowing as a particular day on the 31st of March. So quite often that will straight away the day after it'll be quite a different picture, and particularly for short-term borrowing, because in February and March we don't get as much council tax and business rates. Therefore, it's quite common for local authorities to take out short-term borrowing in the months of February and March, and then in the new financial year, April and May, you get an influx of cash in terms of council tax, business rates, government grants that sort of offset some of that short-term borrowing. But I think it was known and it was planned for in terms of our capital programme. We're investing a lot in new assets that are generating future savings and income streams that will pay for that borrowing. So there is a timing issue as well, where we invest up front and then we get the benefit over a number of years. The accounts don't sort of show that picture. I think we said in the answer the best place would be sort of the Treasury management outturn report, and the mid-year report that goes to executive gives a better sort of position of the council's borrowing, short term, long term, and our plan to maintain that over a longer period of time.
And
yeah,
I think
thanks.
If I could just, sorry, Chair, sorry, just I think in the sit for training we discussed with members about maybe forwarding on links to some of the Treasury reports and the budget monitoring reports, so you've got that wider context. So that's something we'll look to do, which may help members with that going forward.
Okay, thank you. Graham Evers.
Oh, thanks, Rachel. Yes, sorry, I was just beaten to it. I was just going to reference the Treasury management strategy, set out those permissions, and this is not irregular. Short-term borrowing happens as set out in that strategy.
Okay, any other? Yep.
Thank you, Chair. I just think that where I feel we've come to in the last couple of months with the training that was provided with this new process where the accounts were sent out ahead, opportunity was given to send in questions and get answers ahead of this, and where this has now got to just feels worlds away from where we were just as recently as 2 or 3 months ago. And it's already been said, but I just want to echo what's been commented on. This has not been done without significant effort, and I just want to sort of again thank the auditors, but also most importantly our own staff and the officers for the significant effort they've put in over the last few months to get here. Graham Evers already said that they're trying to balance several years of worth of work in a very short period of time, and we can't discount that either. Because we haven't been able to expand the team to deal with it. It's all got to be done by the same people. So I just wanted to say thank you very much for that. And I have no questions because I think you've done such a good job in the process and in answering the questions that have come through. So it's not that I'm not interested, just that you've already done it. So thank you.
Thank you very much. I had a couple of points on the narrative. So I can see this, Mike, you've got your hand up. I will come to you. The first one is, it's really for KPMG actually, in terms of the narrative report and the checking of that. So I know this is something we've picked up before, but if we look at page 4 of the accounts, so page 58 of the pack, we've got the figures presented in their sort of budgets versus actuals, and that's presented in the kind of management account style. And that obviously does not tie to the main statements. And I know we have made a comment about that, but there's no sort of reconciliation between the two. So I guess the question is to KPMG as to when you're reviewing the narrative, is that not something you challenge management on in terms of, well, there should be a flow through from any figures presented in the narrative that should tie to the actual statements themselves?
Yes, that is very true in terms of non-GAAP numbers. Obviously, this year is slightly odd because we're issuing a disclaimer, so we haven't as we haven't raised that issue, but it's a fair one to raise. Normally, you would have to produce a reconciliation back to a GAAP term that is shown in the accounts. So we can pick that up with Graham during this year.
Okay, thank you. The second point on the narrative, it's page 63 of the pack. So that's page 9 of the account. So we've got this, so I guess there's a question for Graham Eaves actually. So we've got the settlement funding graph in here that we're all fairly familiar with, showing how low the settlement funding is for Wokingham. But what it doesn't obviously show is the overall spending power. So it doesn't show that actually Wokingham, we are in receipt of a relatively large amount of council tax compared to other authorities. So is there a case of saying we should actually be showing the full, core spending power of the council as opposed to just one element, which is the settlement funding assessment? In terms of how the reader of accounts, the fairness from a reader of accounts point of view, why do we just pick out that element of our sort of overall income rather than showing the core spending power as a full amount?
Thank you, Chair. I suppose it depends on one's perspective. And these graphs have been put in place over many years and used to just focus on what was called revenue support grant, which was your main funding from the government. And the intention was to show how that, as in the additional money to the council, external, as in independent of the council taxpayer, how that money changed over time. I still passionately believe that it's a reasonable view to look at just the core grant spending, because that's the external money that comes from the central government. Bringing in council tax under a new terminology called the corporate spending power. Yes, core spending power. Core spending. Yeah, that's right. That's the one. Core spending power was only introduced about 7 years ago. No, obviously that's about that time. I've had many years where that notion did not exist, that the government didn't look at all the available income. And they're not anyway, because they're not looking at car park income, they're not looking at tourist income, they're not looking at all sorts of income, but just a decision was made at some time to introduce council tax into the calculation. I understand that as an argument, but I would say that's not the whole story if you're going to bring other forms of income in, because that's only one part. And I would say it's still valid to look at the grant money that the council gets to try to press home the fact that Wokingham Borough Council and its council taxpayers should ensure that it does what it can to get the best fair grant, should I say. So I think it's valid to, even though this CSP has been introduced, to dissect them and look at just the grant lens. But I appreciate there's another way of looking at it, and other people do. But I think once council tax was brought into that calculation, it was severely detrimental to us, because we received one of the lowest level of grants and therefore relied on the highest level of council tax. So our gearing on council tax, as in percentage of services funded by the council taxpayer, was more significant than anywhere else, because it had to be, because we had the lowest grant. And even if, cost of services are average, let's say. So I guess I found it quite galling when council tax was brought into that calculation, because that will only penalise us from the starting point that we had. Sorry, that was probably quite a longer answer than expected.
Thank you for that. The only other point I had was just to come back to the casting, and I know we've already mentioned it. I mean, it is disappointing that we still have the casting differences in there, and some of them are on the primary statements. But I do understand the sort of reasoning that's been given for that, and I really just want to sort of reiterate that we've got your assurances that for the next set of accounts we won't have these casting errors. We want a professional set of accounts that won't have them. So I think we've got that as a committee, so that's helpful. I can see Mike wants to come in. Mike.
Yes, Rachel, thank you for raising the narrative report. The accounts are prepared under IFRS, but I do understand that day to day you're managing on a different basis, management basis, you could call it. But I would be quite interested what other unitary and other authority accounts, how they actually do that. And I wonder whether maybe we could look at some other, say, unitary authorities and how they deal with this issue, because really the narrative should be on the same basis as the primary statement numbers, the IFRS numbers. So I thought that might be a useful exercise. I did very quickly look at Reading, so I wouldn't necessarily hold Reading up as a great example, but they have a more modern feel. If you look at their annual report as well, there's lots of bar charts and pie charts and colours and things like that. So I wondered whether, trouble is, I know these things, it's finding someone with time to do it. And it doesn't necessarily have to be your area, Graham. It could be more governance or something. But whether someone could do that would be quite beneficial. What I was going to raise, follow up though, was the Treasury point we were just talking about that Rob was raising. And a lot of public companies now, they actually, although it's not a gap number, they monitor net debt. So they look at their long-term debt, they look at their short-term debt, they probably put in finance leases, and then they take off any cash figures. And they very much, their key KPI is that net. So if you look at that at the end of the year, if a loan suddenly paid off on the last day mark, now going to cash or whatever, that their KPI is the net figure. And I don't know whether local authorities ever look at that, but that tends to be now how listed companies like their cash and borrowing figures to be monitored. So I don't know if that's any help to anybody. Thank you.
Yes, thank you. I can say that we've introduced a terminology called net indebtedness into our Treasury management strategy about 3 years ago, maybe a bit longer, which seeks to do that very thing.
Excellent, thank you. Maybe we can bring that out in the narrative in future years then. Thank you.
Okay, Jonathan, I can see you've got your hand up.
Yes, I just wanted to say two things. One was agree with the challenge on the front of the annual report and the management to statutory. So I've taken that away as an action, and we'll get you some good examples on that. Secondly, I saw Mark online, and after Graham's kind words, I only felt right to say, when I speak to my team on the ground, they said it's gone well because of Mark and Deborah. And the other thing that we don't see elsewhere is when you go outside of finance to the estates team, to the payroll team, that they were great as well. So I just wanted to give that credit where it was due as well.
Great, thank you very much for that. Okay, any other comments on the main set of accounts? Yeah, Martin.
I had a question, because I know we're struggling with the dedicated school grant. Yeah, we're having an overspend there. And, potentially that can increase even worse, and it poses a risk to us. But I couldn't really find that one in the report, or saying that. Where could I find that particular risk? Sort of, it didn't stand out to me. Well, I know it is a risk for us.
I'll just start by saying you're absolutely right. It is a huge risk. Yes, I can see on page 73, page 19 of the statement, it does mention the challenges around, it's under corporate risks. It does areas of significant change, corporate risks, bullet point 2. It does tease, it does tease that out. But you're absolutely right. And I would say in my Chief Finance Officer's report that went to Executive in January, and its updated version will be going in the MTFP to Council, put a lot more information and explanatory around that issue and the impact of that issue.
But will that impact the general fund, or would it come out of some other usual or unusual reserves in the future?
That's a really good question. So there's actually a statutory override in place on the DSG, which means it is law, so it applies to every local authority in England. And that statutory override says that the DSG accumulates its deficit and it does not impact on any other part of the council's balance sheet. So it's seen as off balance sheet, and that's the terminology that's used. That statutory override has only been guaranteed to the 31st of March 26. I would be massively surprised if it wasn't dealt with either through an extension or other means, because if they took it away, the number of Section 114 notices around the country would be immense. Maybe something like 40% of counties or upper tier, is that sort of extreme. So something will happen. However, to answer your question more fully, although that statutory override is there and it's protected from the rest of the council, it's not really, because that is a deficit that needs to be funded either through lost investment opportunity or borrowing. Either way costs us about 5%. So every pound is, or every £1 million or every £10 million is generating 5% interest cost or interest lost, which falls on the council taxpayer, which I think is entirely wrong, and we as a council have expressed that view to whoever might be able to do something about it.
Okay. Is that okay, Martin?
Yeah. No. That explains it. Great, thanks. The other one is like, I know we've also invested in commercial properties in the past, and these are not just in Wokingham, but even sort of outside. Are these part of that if you go to the CIS, is that part of the financing and investment income and expenditure? Note 9 and then goes into... Don't know if that was... And do they... Are they sort of paying back? Are they these investments liabilities, or are they sort of neutral for us?
Okay, I'll answer the last bit because that's easier. Then hopefully Mark can clarify exactly what's contained in that note. I think it's a really important question for a start, because many of the earlier Section 114 notices, being the "we've gone bust" notices, were attributed to poor commercial investments, or one could say, being more generous, very unfortunate, unlucky commercial investments, because at the time they were made, people weren't aware of Brexit, weren't aware of COVID, weren't aware of a war in Europe. All sorts of major events have happened since 2019, let's say. So actually, in terms of world events, it's been tough on those who have made certain types of choices. I will say that we have always been conscious, not of we know what's going to happen in the future, because who could have done, but we've tried to have a diverse portfolio. And that includes our housing companies, includes town centre regeneration, includes the commercial property holdings and how those holdings are made up. And more recently, you'll be aware that obviously we bought an adult social care. That's right, the Bluebell, exactly. And because of that, in the round, we are okay. And I would say being okay is a hugely positive thing to say, given all those things that happened and other authorities, their rental or their income line just disappeared almost overnight, obviously around office premises, for example. So it's diverse, and some areas have done really well, and I'd say one or two haven't done so well at all, but are being more than propped up by others. So it's not something I bring to you as a concern and a risk, but of course any type of commercial, innovative endeavours come with risk.
Okay, thank you. I'm going to move us on, if that's okay. We've still got quite a lot to get through. The final report in this set is the External Auditor's Annual Report. I don't know if, Jonathan, you had anything you wanted to bring out in particular from that. It's fairly straightforward, I think.
Yeah, no, this is, as I said earlier, meant to be a summary of the work we've done. So it says we've completed our audit. We've concluded on the value for money, of which you are clean and green, and just goes through the process of reporting that we haven't done anything else in terms of our other statutory responsibilities. So hopefully you should recognise everything that's in there that we've discussed earlier.
Okay, thank you. So I'm going to move us on to the recommendations for these items. So the two audit reports and the AGS report are to note, as are the accounts. But I just want to draw your attention to page 53 of the pack and the recommendation 2 there, which is that we need to approve the signing of the 23-24 accounts by Graham and myself. So if we're okay to move to a vote on that, are we happy to approve the signing of the accounts? Can I have a show of hands?
Chair.
Oh,
Chair,
sorry, Graham. Go ahead.
No, it's okay. I just wanted to make clear there was a paper issued on Friday that just had some final tabled differences,
Okay, yes.
which were
yes.
the final audited, and I just wanted to make sure that in the vote we were picking up those, and those were like taken account of in the recommendation.
Yeah, thank you. Sorry, I've neglected to mention that. Yes. So when we're approving, it's with the addition of the final tables that were circulated to us last Friday? Yeah.
Friday. Yeah.
So are we happy to approve on that basis? Can I see a show of hands? Okay, that's everyone. Thank you very much. And thank you again to all of the work that's gone into those accounts from the officers and from the auditors. It's good that we're getting back on track finally. So that's great. Okay, so we'll move on to the next item, which is the risk register. So Graham Evers, I think you were introducing this item.
Yes, thank you, Chair. So the corporate risk register is a standard item that the audit committee receive starts on page 25 and sets out what the corporate management team considered to be the most significant risks that need to be addressed and you need to be aware of. The report, in its usual way, sets out changes, updates, that type of thing. So I'll leave you to read that and add further comments, but they're all set out on page 26 through to 29. While I'm here, you might be most interested in exploring the financial risk, which is number one, both in terms of its mathematical numbering, but also number one in terms of its position in the graph. But I'll leave it there for you to ask the questions you feel appropriate.
Okay, thank you. Right, questions for officers on the risk report? Yeah, Martijn?
You also have risk 5, yeah, which is also a bit financy type of thing. And I was having a think about it. 5 is, could 5 be a cause of, if 5 happens, yeah, or becomes a big risk, could that cause something on risk 1 to happen? So I mean, it's difficult to link the two. But is there a bit of a risk if risk 5 materializes? This can impact risk 1.
Yes, thank you for the question. Absolutely right. 5 it references the financials, but also it's more of a broader commentary around the whole of the SEND system. It's because the SEND system, and I don't think I'm being particularly controversial in saying this, because many people would say the SEND system is broken. That's why local authorities are in such deficits, and there are so many competing and contrary elements to it. So this is more of a commentary around the outcomes for children as well as the costs, and references the SEND broken system. For sure, number 1, if, for example, that statutory override was not replaced with anything, I know number 1 can't go any further in the top right-hand corner, but it would.
Okay, thank you. I was just going to pick up on that actually in one of my questions. So in terms of the DSG then, so when we get to that it's March 2026 when the statutory override, that's only just over a year away. So are we saying then if we get to that point and nothing in policy changes that we're in trouble? Is that basically what you're saying?
I'm saying it's a certainty that many, many local authorities will immediately issue a Section 114 notice. At 31st of March 26, we would still be solvent, but it would not be looking good. We have also been given assurances through making our representations that the SEND system, the high needs block deficit, which is in the DSG, and its historical deficits will be looked at and resolved this year. So yes, it would be dire for us. It would be even more dire for so many others. I don't think it could possibly be allowed to happen because of its impact, and also we've been given assurances it would be addressed because this issue is very, very well known about in all quarters.
Other questions? Yeah, Rob?
We're all talking about SEND stuff. Just my question is, I noticed that we're applying for permission to self-build the 2 schools that have been delayed. If we were granted that, what impact would that have?
Sorry, can you just repeat the last bit? I understand we did have permission for, we had the funding agreed for 2 SEND schools, yeah? What was
yes, but those would have been delayed by the DFE. I notice it says in here that we have applied for permission to self-build those. And my question is, if we are granted permission, what effect would that have?
Okay, I know we're seeking to do that, but I'm not confident that will happen. But if it did happen, it would be good news for us because it moves us into a greater place of control and certainty, whereas at the moment we are beholden to where the DFE are on their programme management and priorities.
Yeah, I understood that to be the case. I was just wondering if we had any clue as to what financial impact that might have.
None. It should be basically the money will be there. It's just who builds within that money that's available. So it should, if anything, it would have a positive impact because I believe we would have certainty of earlier delivery.
Okay, so the budget that's been provided, so I interpreted that the self-build as self-fund, but it's not that, it's just self-build using those funds. Great, thank you.
That's correct.
Okay, thank you. Can I ask about the general fund balance? Obviously, that's key to our sort of position and our overall kind of financial robustness. And looking at how it's tracked over the last few years, it was sort of 12.4 back in 2020, and then it fell quite sharply around 2022, and it's sort of gone back up again. So the forecast for this year is 10.7. Looking ahead to next year, and I know in previous years we have transferred funds from earmarked reserves as part of the MTFP. What sort of level of transfer from other reserves do you anticipate in the MTFP coming up? And which earmark, if there are some, which earmarked reserves is that being transferred from? I guess I'm trying to kind of get a sense of how we can get assurance that that's being done in a kind of a reasonable way and not a kind of reckless way, how we can get assurance over those movements between reserves.
Okay, I'm going to do my best to remember the answer. Some bits I'm certain about in terms of the overall reserves position was reported, and for the second time, so it's an annual occurrence now, the overall reserves position was reported to Community and Corporate Overview and Scrutiny on the 7th of October as part of the overall budget consideration. In January, I updated Overview and Scrutiny on all the movements that have happened since December, which included the outcome of the draft local government finance settlement, which was a key piece of the jigsaw, to enable me to then bring these other pieces into play. There was about a £3 million gap in terms of ongoing expenditure exceeded ongoing income, and they were found from, and Mark Thompson may have a better memory than me, one was from the council tax, which had a surplus, council tax collection fund, which has a surplus. Another part was from the, I believe it was the town centre reserve, because we've moved further into completion. And there was one other place, and it might have been the general fund, but it leaves our general fund forecast for March 26 at about 10.2 million. So so we remain forecast above 10.2, having utilised the general fund to some extent, but also tapped into other reserves in a safe way. And the rationale, the specific callings from those reserves and the rationale was reported to Overview and Scrutiny. So I guess in many ways I'm saying your assurance in the main comes from my reporting and accountability to Overview and Scrutiny as they undertake the MTFP budget cycle.
Thank you. Other questions on the risk register? Yeah, Stephen.
Thank you. I just wanted to sort of try and make sure I'm reading this right. This may be a question for Mark or for Andrew, I guess. But it seems to me that there's two types of risks, largely. There's the ones that you have no control over and you're just a victim of. And that seems to me to be what we're talking about with like the send situation, where that we are reliant upon the government to put something in place. We have to take reasonable steps and do what we can to improve things, but ultimately there is an element outside of our control. But when I'm scanning through this, it just seems to me that everything I can see, which is down to the council and down to our own officers, is on track, and that's across the piece. And I thought, well, that's really good. That's because we weren't there, I don't think, a year or so ago when I was first on this committee. So I suppose my question broadly is, am I right in that assessment that that's what it's telling me, or have I misread the report?
I'm happy to start. Well, you're absolutely right. I mean, for a start, these are all the issues that the corporate leadership team are most concerned about, which is, and we go to our enterprise risk management approach. A lot of these stem from like service risk, directorate risk, and then they get escalated up here. And within them, some will be a lot more controllable than others. And you take the finance one, for example, there's an awful lot we can do around improving our financial management. We've just talked about our statement of accounts and finding savings initiatives or commercial opportunities. So much we can do, yet outside of keep making representations to wherever we cannot change the legislation or national regulation on the statutory override. And I think that applies to an awful lot of these. So there's influence, control, and sometimes a begrudging accept.
Thank you for that. That does sort of confirm my own thinking. Because I think with all of these things, whether you're in a council or a corporate environment, whatever situation you're in, when you're faced with challenges and difficulties, there's two ways of responding largely. You can either just put your hands up and say, woe is me, and we're all doomed, or you try and sort of make the best of it. And what it seems to me from looking at this and how we've seen progress over the last couple of years is that the officers have really sort of applied themselves and are seeking to do everything possible. As you said, there's areas you can do stuff in. Some of it takes longer than others. But I think it would just be nice to, if we can recognise the effort that's going in to put us in this position, because we've already looked at that table which showed that we get a fraction of the money of some of the other councils that we know are really struggling around us from central government. Yeah, we can look at core spending, but the real metric is per head, I think, in that way, in terms of what the government does, and looking at council tax raised per head and so on. But it just strikes me that actually, considering what other councils that have got equally zealous and keen people, we are in a very much better place. And I think that is very much down to the calibre and the hard work of our officers. So just want to sort of thank them for all they're doing, for the residents to keep us in that position, because if we were not many miles away, it could be a lot worse. So thank you.
Thank you. Could I just raise on risk 24? So this is the change in waste collections. Now that's obviously been rolled out, so a big chunk of that risk has gone away. Is it been considered as to whether that needs to stay on the high level risk register now that it's, and I know there's, there's measurements we need to, there's monitoring, and there's a second phase to that obviously, but is there consideration of whether that needs to stay there?
No, it's a very good reflection on that one, and I think that may well disappear next time you see this.
Okay, thanks to Mike, because it was Mike that pointed that one out to me earlier. So any other points on the risk register?
Just a question, maybe we can't answer this one, but devolution is an emerging risk. It's very difficult maybe to get an opinion about it, where it goes. But I also like to get maybe ask, do we have an idea when we could sort of get a feel for that one, of what the impact is or where it goes on our risk register, or is that even that we can't say at this stage?
Yeah, we did talk about the policy statement, both with regard to devolution and local government review, and really felt that at this stage we would reference it in the opening report. So it exists, we're naming it, we know it is talked about nationally and locally. However, there is a lot yet to be understood. There's a lot to unfold in terms of what our possibilities are. And I think what I would want to remind everyone, because it's often conflated, is devolution. And I know you didn't mention local government review, but the two are quite commonly conflated, and they're two different things, albeit they came out with the same policy statement. And seem to have the same provenance. But I think it's clearer that they are two very different things, albeit there is some alignment there. And I suppose the best update I can give you is council receiving, will receive, has it happened already, the paper on devolution? January council, yes, happened. Yes, so council received the paper on devolution. That gave permission for the leader of the council to embark on discussions, and that is what's going on.
Okay, thank you. If there's no other questions or comments, we'll move on to the next item. So thank you, Graham. Huh? No, he's not got his hand up. So, okay, so the next item is Audit Committee Effectiveness. Is Paul online to introduce this one? Or not?
Yes, I am, Rachel.
Oh, sorry, I couldn't see you. Good. All right, over to you, Paul.
That's right. Okay, so this is our annual review against the SIPFA position statement on good practice for audit committees. Essentially, it's 40 questions that span the whole remit of the committee, including purpose and governance, its core functions, membership and support, and its effectiveness. So essentially the outcome of the review is identified 4 areas for improvement where we think we can strengthen the committee, but the overall position is an improvement from last year's position. So that reflects some of the improvements that we've made in terms of the report to annual council, the knowledge and skills survey that the members of the committee completed, and the self-assessment results and value are also reflected in that report to council, and also the reports that committee has received in the past year are very clear in highlighting the role of the committee in relation to fulfilling its terms of reference. So those are the improvements from the last review that we completed. There are 4 areas where we can further strengthen the committee's role in future, which is sharing the knowledge and skills with the political leadership prior to appointment to the committee, increased stakeholder feedback, the range of leaders and managers that appear before the committee, and look at how we complete this self-assessment for next time. I think the approach that we adopted this time wasn't as engaging as possible for the members of the committee. So for next time, I'm looking at holding a workshop where we can discuss in November where we think and go through the position statement and the 40 questions. So I don't know if anybody's got any questions for me.
Thanks, Paul. Any questions? Yeah, Sam, and then Stephen.
Thank you. I just wanted to say, speak on behalf of the members, that we all really enjoyed the training the other week. I thought it was very useful, and considering what is quite an intense subject, the actual present was very engaging as well. So just thank you all for arranging that, and yeah, myself found that very useful, and yeah, a lot of the members did too. So thank you.
Thank you, Chair. I just wondered, Paul, I mean, I thought the report was great. I mean, to know that we're doing better and therefore serving our residents even better is fantastic. The question I've got is about the recommendation 2, about feedback on performance. Can you just spell out for me what it means by a broader level of stakeholder feedback could have been achieved? I didn't quite understand exactly what you were saying to me there.
Okay, so
Sorry,
God, sorry, Rachel.
Do you mind if I take that one actually? Because
you can, yeah.
I think I think this does make out that we're really sort of glowing review. So I think we do need to make sure we're not sort of complacent here. And one of the areas we can look at is stakeholder feedback. And I think we can look at getting feedback from the internal auditors, the external auditors. How do we do compared to other audit committees? What do other audit committees do that we don't, that we should be doing? I think we can get feedback from some of the senior officers as to how well they think we function in terms of our responsibilities. So I think it's just getting a broader pool, not just our own self-reflections on how well we think we're doing. And we have made improvements, and I don't want to sort of do us down, because we have made improvements. But I think that we can't be complacent, and we should be looking at a broader pool and the public as well. How are we serving the public? Is there a way that we could get feedback from the public and other members that don't sit on the committee as well? So that would be my input into it. Paul, I don't know if you wanted to add anything.
No, perfectly agree.
Yeah. Okay. Thank you.
Thank you.
Any other comments on this one? No? Okay. Thank you for that, Paul. We'll move on to the next item, so we've got two internal audit reports here. So the first one is the internal audit update. So over to Catherine for this one.
Okay, thank you, Chair. So this audit report summarises the work of internal audit and investigation in the first 9 months of the financial year. So that's to the end of December. And I think you're all familiar with the report now. I think the main part to focus on is the Appendix A1, which is on pages 82 to 85 in the agenda pack. And this lists all the work in the 24-25 audit plan and the status as at the end of December. So that's where audits are finalised, draft report stage, work in progress, or not yet started. So for the audits that have been finalised in the quarter, there have been none that have attracted the lowest category of audit opinion. That's category 3 and 4. So there were none in that category. And since the report was prepared, a number of audits have moved on. So just to give an update, the procurement audit has been now finalised, as mentioned earlier. Also, contract management should be finalised within the next week or so. And the equalities impact assessment has gone out as a draft report today. The other area I'd focus members' attention on is the high-risk concerns, which is the table on pages 74 to 76. There have been no new high-risk concerns since I last reported in November. 3 high-risk concerns have actually been closed now. 2 on contract management and 1 on recruitment and safeguarding. And the current position on each of those high-risk concerns in terms of implementing the actions is outlined on pages 74 to 76. So all are progressing. I just mentioned about the 2 oldest high-risk concerns. So we've got the reconciliations concern, which has been outstanding for some time. And a member of my team has a meeting with the auditee tomorrow, and we anticipate that we'll be actually able to close that one off now. And the second one is the right to buy audit, and the date for that to be cleared is the end of March, so we'll be shortly chasing that one up as well. So other than that, there's nothing more specific to draw to the attention of the audit committee, and the report's coming to committee tonight to review and scrutinise, and I'm happy to answer any questions.
Okay, thank you very much. Any questions for Catherine on the update report? Yeah, Martin?
Just for my own understanding. So, if you looked at the actions, some of them said it was superseded by the next audit.
Yeah.
Does that mean then that, if you have a 3-year cycle, it wasn't closed out in those 3-year cycle, and would it then turn up as a repeat finding or something like that, which could impact an audit opinion?
No, it's just where we've undertaken an audit again. So we might say, example, key corporate risk 1, for example, we audit every year. And it may be that when we've gone back to revisit it, things have changed, and that's not a high-risk concern anymore. And there are some that have gone down to be medium-risk concerns as well.
Okay, so if it's
yes, in terms of the overall opinion on that audit, it would get reported on that next piece of work, how the opinion has changed, if it has.
So basically we're saying they don't kind of get lost in the new audit and sort of, they don't just, it's
yeah.
Actually,
yeah.
it's an improvement. Could be an improvement, not like a repeat finding.
Yeah, no, maybe a process has changed, and so that wasn't a concern anymore because it's been addressed by the new process.
Okay, any other questions or comments? Oh, another one here?
Cyber security, that is done externally, it's said, or is that right?
No,
Maybe I misread it.
We've undertaken the audit on cybersecurity internally. We've done reviews of self-assessments within that area. So we did that a couple of years ago, and then last year we followed up on the findings that we had.
And then 3 were deferred, I suppose, 3 audits, is that right?
Sorry?
3 audits have been deferred to a later stage? I saw on page 82 and 83. Is that a concern for you, or?
No, there's normally good reason if an audit's been deferred, so just getting the correct report. That was because the processes hadn't been developed yet. They were going to be looking at new processes for service level agreements, and it hadn't got to a stage where we were able to undertake that audit because things hadn't changed at that point. So we deferred it into another year.
But as long as there's no concern for you,
No.
It's as long as you've got
No,
enough audits to be able to do your opinion, that's the key point, isn't it? Yeah.
I mean, that was quite a minor one at the time anyway. It was just, it was a directorate request at the time, so it wasn't one of the key corporate risks, basically. So.
Okay, I think that's all very clear. Thank you, Catherine. So if we could move on to the second report, which is the plan and the charter.
Right, so there are two parts to this report. There's two parts to the report. The first part is Appendix A and A1, and that is the internal audit strategy and the draft internal audit plan for 25-26. So the internal audit strategy explains the approach that we take to producing the internal audit and investigation service work for the forthcoming year. And it's all aimed at informing the head of internal audit opinion on the Council's governance, risk management and internal control framework. So the methodology that we use to prepare the plan and strategy has been mentioned in the report at page 95, but just to summarise, we take consideration of advice from our accounting and audit bodies and audit networking groups. We also use the corporate risk register to inform the internal audit plan where possible. And there's a table on page 98, and you'll be aware that as part of our audit strategy, we aim to cover all the key corporate risks over a 3-year cycle. In addition to this, I've attended Directorate Management Team meetings and CLT, where we've discussed corporate and directorate priorities and risks and looked to where audit can actually add value and assist in the organisation. And over the last year as well, there's been a number of audit committee member requests to be considered. So I've gone back over the last year and I've incorporated those as far as possible. But we just need to bear in mind that we need to balance this out with available audit resources because we are quite a small audit team. Also, over the year, we've mentioned value for money aspects in doing our scoping. So I've mentioned in some of this plan where we're going to be looking at value for money. So as well as focusing on key corporate and key operational risks, we have other elements in the plan, such as governance building blocks. So this is looking at areas such as risk management, general governance issues. We undertake quite a number of grant certifications. We have our fraud and investigation activity. And we have an area called auditor judgment, where something might not fall within the corporate risk register, but we feel as auditors that we need to undertake some audit work to get some assurances. And then we've also got provision for advice and consultancy work. And in addition to this, we also take account of other assurance mechanisms across the authority and place assurances where we can. So, for example, Ofsted inspections. I know Children's Services got an LGA review coming along, so we will rather than duplicate work, we want to be as efficient as possible. So, as I say, we are a small team, so it has been quite a balancing exercise to take all that into account. In terms of coverage, you'll be aware that our senior auditor role was vacant for 2 years. It was frozen to help contribute towards council savings. And this plan is based on the assumption that we will fill to that vacant role, and I'm just going through HR processes at the moment to recruit. Excuse me. And so Appendix A1, which is pages 103 to 105, outlines the work areas that we're proposing to cover in 25-26. And in terms of the scopes there, they are quite high level at the moment, and we'll expand on those audits when the audits are due to commence, so there'll be further detail that will sit behind those. So I will pause there. There is a second part to this report, but if members have any questions, this part of the report is coming to committee to review and scrutinise.
Okay, thank you. It's really pleasing to see the feedback from the committee in your plan, so thank you for that. Okay, I can see some hands. Rob, do you want to start?
Yes, thanks very much, Catherine. When you're mentioning the value for money, I just want to make sure that we're talking about the same sort of value for money, because we raised the issue previously about the value for money work being done by the auditors, which are very much looking at the processes, not the actual bang for your buck. And we raised the issue, I think, with yourselves, of looking more at that. Is that the value for money that you're talking about? Because I noticed when we're talking here in the place and growth, we're talking about review of the way work is ordered, packaged, and so forth, which is a process as opposed to bang for buck type thing. I just want to check and make sure which type of value for money you're talking about.
Right, so it will be looking at, you know, the costs, efficiency, effectiveness, looking at benchmarking with other organisations. So we'll be drilling into a bit more of the detail. I don't know if that helps, or am I missing something?
When you're benchmarking, are you benchmarking, if you like, the performance against the contract, or just the type of contract?
I think that will come out as part of the scoping exercise that we undertake.
Just to reiterate then the point that was made at a previous audit committee meeting, is that one of the things I think we are perhaps lacking, or maybe we didn't know where to look for, was the actual, you know, I can't think of a better way of saying it than bang for the buck, to make sure that we're actually getting value for the money spent, as opposed to a process that should ensure value for money spent. So that's something I think we need to make sure we keep an eye on.
Okay.
Yeah, I think it probably very much depends on which audit in terms of the approach, doesn't it? But we totally get the point, and yeah, thanks for reminding us of that. Sorry, yeah, go ahead.
Thank you. I just wanted to raise on the value for money issue, obviously internal audit will do value for money, external audit. There's all sorts of ways that we seek assurances around value for money. And I would say what the most powerful way that we've received assurance is that Empower, who are a nationally regarded external organisation, worked with the MJ, the Municipal Journal, which is our biggest specialist local government journal, along with LGC. They undertook a national piece of work on all upper tier authorities, which is about 250, 260. And they looked at all the key big areas of expenditure, waste, and social care and housing and what have you. And we were found to be the 5th highest performing in the country. I'm not saying that's the only view and only lens by which we look at value for money, but it's a pretty powerful one, and it adds to all the other assurances we can get.
Thank you for that, Graham. Steve.
Thank you. Thank you, Catherine. It's really interesting what you were saying, and I do appreciate you trying to take on board feedback and stuff. If I can just draw your attention to page 103 and the adult social care supply sustainability and sufficiency audit and scope to be agreed. I think this may have come from comments I made a few months back, in which case, thank you very much, first of all. But just to remind people what I was specifically interested in at that time was to do with where major adaptations are being done to help our residents, and looking at the efficiency of the process, getting it right first time, and making sure that we weren't over providing, so the equipment that was provided was fit for purpose, not necessarily top of the range. And also getting it right first time, so we didn't have to keep going back and replicating things or changing things numerous times. And that's thing. I do understand that needs can change, therefore it's not a question of that if the need changes, the solution may change. But if you have a need at the start, then you should try and aim to get that right the first time you do it, rather than having to have several bites at that cherry. And also the inter-team working to make sure that things are working efficiently, because you can lose money through people having to spend time on stuff that's inefficiency. It's not just on the equipment and the kit that's bought, it's the process can cost you as well. And obviously if things are necessary to make someone's life better now, then if it takes them months to receive that and it then takes longer to get it sorted out, then that obviously can be quite disadvantageous to the individuals affected by it. So that's where I was trying to come from. So I just wanted to sort of reiterate that a bit. So if there's a way of trying to incorporate any of that or all of that into what you're doing, I would, for one, greatly appreciate it. Thank you.
Okay, on page 105, that is the audit that you're referring to. The second one down, aids and adaptations. Okay. Yeah. So hopefully I picked up some of the narrative that you'd mentioned at the previous committee meetings. I can add those extra parts in that you've mentioned now as well. You
have indeed.
Yeah.
So I didn't get it under that bit in terms of the heading, but thank you. So that's brilliant. I really appreciate it. Thank you.
Sure, go ahead.
There's a little bit of a follow-up on that one, because I noticed we have a home-to-school transport audit planned for Q4.
Yes.
And then also in the next years, you have been requested by us and also by the CDLT to do another audit, or is that on children's services, home-to-school transport? And
right, so
is it this? Are you merging them into one audit, or because it seems a bit pointless if you'd already planned an audit and we ask you to do another audit on top of it?
It's basically the timing when they wanted these various aspects undertaken. So there is the one about the appeals process, and at the previous audit committee it was asked that we look at that in a year's time to see how effective it's been. So that is programmed in for Q3. When I visited the CDLT, they did mention about the supplier sustainability and suggested Q4 might be a good time for that aspect of it. So we did have it originally in this year's work, but we've separated that out to manage the timings, basically.
Thank you. Can I ask, on page 98, you've got the really useful chart where it shows each year and which risk you're covering in each year. You've got, obviously, number one, the budget and financial risk that you've got in every year. That's our top risk, and so that makes sense. The other risk that's very, very high up that we've already mentioned a number of times is number 5, outcomes and costs for children with SEND. And that's only in one of the 3 years. Is there a reason why, I mean, have you sort of considered, because that's so high risk, that maybe it should be in 2 or 3 out of the 3 years?
Okay, so that's an audit that we're undertaking at the moment in 24-25. It's really basically trying to balance with the resourcing that we have. So it's quite difficult. I know we discussed as well in the previous audit committee about 21 and 22, perhaps looking at those every year. But I think as things move on, this is a fluid plan anyway, so things may change. So it's just something we can keep an eye on, basically.
Okay, and then one other question on this. So number 14, which is children's safeguarding, is due in the coming year. Where is that reflected in the list of the audits? Should that be on page 103 somewhere?
I think that was fallen out.
Okay.
To be honest, I'll have to put that one back in again.
Okay, fair enough.
So it's an addition.
Okay, all right, thank you. Okay, any other comments on the plan or contributions from anyone? Oh, Mike. Mike, are you there? I think you may be on mute.
Yeah, there we are. Thank you. If I could refer the committee to page 33, and that's the summarised corporate risk register. You see in the top right-hand corner, we've got those 4 risks that are considered very high. So that's risk number 1, which is finance. We've got children with SEND, we've got adult social care, and we've got site. But if we now, so remember those, now go forward to page 98, which is our 3-year plan of audits. Other than financial resilience, those other 3 very high risk identified areas, we're actually at the moment planning to go and do audits in those areas, in certain parts of those, in only one of the next 3 years. And I think it's great we're covering every area, and that table illustrates it. But I was slightly expecting, and I think you referred to it, Catherine, that areas that are very high risk, maybe we ought to be doing work in those areas perhaps a bit more often than 1 in 3 years. And I think when other internal audit plans I've seen in the past elsewhere, they would address that because they are high risk. So I don't know, really it's one for the committee members and the councillors to think about that, I think.
Thanks, Mike. Graham, did you want to come in?
Yes, if I can. Although I understand why Catherine would use the corporate risk register to inform her work, I think it's not translatable to say high risk area equals needs to be audited. So we take an example, well, a lot of the risk around 5 is the legislative system and how schools, parents, even the legal system interface and the accountability without authority at times, you know, with a local authority, for example. In 1, there's loads of things that, of course, there's making sure that treasury management processes, but there's loads of things. The outcome of the finance settlement is the biggest risk, which Catherine can keep auditing that every single hour of the day. It's not going to change what the government determined to be a 3-year local government finance, or indeed the statutory override view. And same is true of the adult social care supplier market. So they're there, they're really important. We need to attend to them in every way we can, but it doesn't necessarily mean it's a good use of Catherine's time, because sometimes there's little that can be done that Catherine could effect.
Just to supplement that as well, we have actually got key corporate risks 1, 7 and 8 in the plan on page 103. The only one that isn't there is the key corporate risk 5, the SEND one, which, as I say, we are looking at this year. So we have got 3 of the 4 covered.
And as you say, it's a fluid plan, so you know we can review that again. Martin,
I think that Graham's explanation is very good, and I think maybe, Catherine, in your paper, maybe you explain why those very high-risk areas we're only looking at once in the next 3 years, and that sort of just closes that loop then. Okay. So we have considered this, but because of this reason, we won't be doing it every year, even though it's very high risk. Yeah. And then you can't be criticised for not looking at it.
Yeah, that makes sense. Thank you. Martin, did you?
Yeah, I just wanted to, I mean, Mike already commented on it, that I think sometimes these internal audits are better to looking at blind spots that we don't know that we have. Yeah, well, if it is a key risks and we know it's happening, then having an audit might be a bit of overkill, and sometimes that's why I also think it's Catherine's plan to spread it out. No, it's maybe better for the organisation than just focusing on the key risks with audits.
Okay.
That Mark already came with that.
Yeah, thank you. All right. Okay, can we move on to the internal audit charter then, which is something we have to approve? Catherine.
Right, so the second part of the report is Appendix A2 on pages 103 to 108. And the audit charter is always presented alongside the internal audit plan. It's a terms of reference for internal audit, and you'll be aware that there are new global internal audit standards that are due to be implemented from April, and so we've updated the charter to reflect those standards. So there's a clean version of the the document, and then a version with track changes in there. And this is just to say as well, in terms of the work on the global standards, we're still undertaking self-assessment to see the impact of the rest of the standards. So this is just referring to the terms of reference. And I'll be reporting on the outcome of that self-assessment exercise at a future audit committee meeting. So the report, this part of the report is coming to audit committee to approve the internal audit charter.
Okay, thank you. Questions for Catherine? No? Okay, are we all happy to approve that then? Yeah, can I see a show of hands? Okay, thank you very much, Catherine. Okay, so the next item is the Audit Committee Annual Report. Andrew, are you introducing this one?
Well, just very quickly, Chair. So this is the report for your consideration tonight that would be presented to the council meeting in March, representing the work of the committee over the last 12 months. I think it's pretty self-explanatory. Just 2 points I'd make. One is the point that you made earlier on around gathering feedback. So I think presenting this annual report to council is one opportunity that you can open up that question of receiving feedback from various parties. And the second point I'd make, I think in the light of the decision that you took earlier this evening around the 23-24 statement of accounts, that needs to get reflected in the annual reports. But that's it, I think, Chair, in terms of a summary.
Okay, thank you. So are we all happy that that's a reasonable reflection of the work of the committee? Are there any changes that members would like, or are we content with that as a report? Yes, Stephen.
I was very happy with the report. I just wanted to reflect on what you said earlier about the sad loss of Sandeep from the committee. I just wondered, are we actively looking to replace, or maybe you can provide an update on that, because obviously it's referenced in here, but I didn't see a comment about what we were planning to do going forward.
Yeah, we will be going out to recruit again. I don't know if you've got an update, Andrew.
Yes, Chair, it's actually on page 124, the top paragraph. It does actually reference that we'll be looking to unappoint a replacement independent member, hopefully in time for annual council in May. So annual council can see the new independent person be appointed there.
Okay, so subject to those couple of tweaks, we're happy with that report. Okay, great. All right, so just before we finish, in terms of the forward programme for the next year, just a few things to mention. One thing we talked about before was a potential merger of Audit Committee and Standards Committee, and we were going to have a look at that. However, Andrew's very diligently noticed that SIPFA guidance clearly states that we should have a dedicated audit committee. So actually, we're not going to be pursuing that because we want to obviously follow best practice for SIPFA. So that one goes away for now. Other things we will be looking at, so lessons learned from recent local authority failures. That was referenced earlier. That's a key thing. I know we did that a few years ago, but we need to come back to it. That will also encompass some of the comments we've had from I know Mike's raised this in terms of the commercial side of things and perhaps some of our subsidiaries that we've flagged previously. So looking at lessons learned. Assurance mapping is something we need to come back to in the future as well, because we started looking at that, but we need to finish off that piece of work. And lastly, as we said, the feedback on the committee, I think we need to look at how we do that better. So in terms of forward programme, that's what, as well as the usual standard items, those are the things that we're looking at for the coming year. Okay, we'll close the meeting there. Thank you very much, everyone, for all of your input.